Yeah, so today what I wanted to do was to expand on this idea I was doing in the previous video of the hedge funds and how in my partnerships I consider the idea of promoting other hedge funds, promoting competitors to help the clients to get even more value out of the relationship they get with us, you know. And I was explaining to you, I don't know if you remember in this video that we put 20% there. The possibility of perhaps allocating 20% of whatever deposit in the ideas of this person that has a newsletter and his ideas are working extremely well, right? But the interesting thing I wanted to say was that this example is very good to explain something. You know? I'm not saying that I'm the person with the highest returns out there. It's not what I do. That will be lying, and it's not necessary. My business isn't about lying to people. Actually, the business of investing is actually saying the truth to people and also saying the truth to yourself. Because if you say the truth to yourself, you're choosing something that's good, that's actually good, and you're going to benefit from it. You're not going to even need to sell investments to other people, because if you are really saying the truth to yourself, you will make enough to survive by that. Okay? But what I wanted to say is that I'm not the highest return out there. Other hedge funds, other funds could have different approaches with different ideas, like this person, and that has actually a big company already. He's been in business for many years. But what I'm trying to say is that perhaps with different ideas, he will have higher returns than I, okay, with different approaches. The difference, however, the thing I can make a case about, the thing I could argue, is that my strategy has the highest margin of safety. I can explain that with numbers. However, that doesn't take away that this person, with all the years of experience he has and all the focus he has around, because it's a he, around assets he likes, he actually has very good decisions. And usually this newsletter, you know, I'm looking at his ideas sometime, and they're doing great. And I understand why those do great. However, his ideas are things I will never invest on. Why? Because I invest in value. As I told you, we have the highest margin of safety. And what's the meaning of that? The meaning of that is that, for example, when I see the ideas of this guy, he's not doing anything extremely crazy. But when he buys companies, sometimes he buys companies with a PE of 6. PE stands for price to earnings ratio, which means that in case the earnings of the business stay like the same, you know, if it grows, is you need less years, but the PE basically is the number of years you will need for the business to keep accumulating profits, for them to have enough money, okay, from those earnings to pay you back the price you paid per share, in case they had zero cash accumulated, right? Everything adds to whatever they have accumulated already. But that's the second point. When I see the ideas he invests on, sometimes he buys businesses that are $2 on the dollar, you know? Sometimes lower, sometimes higher. And what's the meaning of $2 in the dollar? There's something called common stock equity, which is the cash, assets, and other things valuable that are free of debt, okay? So in case the business decides to stop operating and close and basically sell everything and pay investors, as you will see in my book, I write about a recent historical example of that, of a company which liquidated drilling equipment and paid investors a huge dividend. And basically, if you bought it when it was undervalued, you will end up multiplying your money by 2.5 in 1 year and months, right? but because they liquidated the drilling equipment to pay debts, and then the amount that was free of debt was paid to investors. However, what I'm trying to say here is that when you invest in businesses that are $2 in the dollar, if they close operations, they only have $1 to pay you for each $2 you invested in the stocks, right? It's like a company that has $1 million in cash, but you pay a market cap per share of $2 million, okay, to make it simple. And the difference between this hedge fund and my fund is that when I buy assets, I'm buying at 25 cents on the dollar. Sometimes lower, sometimes I pay a little bit more because I think the earnings are much better, the growth is much more interesting. So I will sacrifice buying the 25 cents on the dollar to buy instead 35 cents on the dollar, because I'd rather have 30 cents on the dollar that grow much faster, because in the future it's likely that that stock is going to be more undervalued. Okay? However, I buy 25 cents on the dollar. And what's the thesis behind it? What's the strategy that's different from this person? The strategy is that the world is insane in many things. They cannot focus on all the things they should focus on. And I could first bet that the world will stop being insane and will go to normal, and they will start giving fair valuation to everything. However, I don't count on that. I'll rather count on the world keep being what it is and what it has been, how it has been existing for the last 100 years, 200 years, or since the beginning of capitalism, which is undervalued things tend to stay undervalued. However, what we expect is that perhaps you buy at 25 cents on the dollar, and tomorrow, if you don't want to keep the cash flow, you can sell at 40 cents on the dollar, which is an increase over 50% in this case. So then when the small increase happens, perhaps by doing research, you find again something that's undervalued, and then you can sell at 40 cents, and then you do like a cycle where you go back and you can buy at 25 cents on the dollar. It's like a cycle. Okay? The difference between this cycle and the cycles this person have is that my cycles are focused in a high margin of safety, because I'm buying something that in case anything happens and they have to sell everything, they have more than enough money to pay me my money back, plus perhaps doubling my money or even tripling my money. Okay? And while these guys, these hedge funds, they focus on stocks that they know they're going to move, in price movements. Maybe they are focusing in earnings, or maybe they're focusing in this company that many institutions and people already are looking at this company, and they are predicting that perhaps in the future a change is going to happen, an improvement in profits, an improvement in earnings, better profit margins, wherever it's going to happen. And then sometimes they're right. Plus, perhaps they go short awful companies, and they're often right? So the thing is that these guys might be great, and I don't deny that. Perhaps these guys will beat me, perhaps they will not. Because if the world goes sane, I buy assets that are ready to triple in value. Okay? But these people here might do great. And the proposition is that if you really want to allocate a percentage of whatever you deposit, go ahead and do it. Perhaps they will do great. The thing is that they don't do things that are safe enough to really put 100% with them. That will be my advice. However, if the purpose of the relationship is to connect with multiple hedge funds, you will have my second opinion always. And I will tell you, I think what these guys are doing makes sense. It's not insane. As I explained to you, these guys sometimes buy $2 on the dollar. Other hedge funds are going to sell you crazy investments in NVIDIA that has a 30 PE that you have to wait 30 years for them to pay you back your money. and they're telling you to make a trade because Nvidia is going to go from 30 PE to 50 PE, and they might be right, you know, and you're going to trade Nvidia stock from I don't know, $700 a share to $1,000 a share, and they're going to be right. However, if they are wrong, if things get bad, and then Nvidia goes from 30 PE to 10, you lose 2/3 of your money, and probably you're not going to get it back. And you're not going to get it back with dividends, because you have to wait more than 10 years, more than 20 years for them to pay back, and you're not going to get it back by the company selling assets and liquidating assets. Okay? So that's low margin of safety. You can explore. You can see if you can find people that do that, and you might like it. You know, simple as that. What I was saying is, you weren't able to see the thing I was doing down here. That we buy at 25 cents on the dollar. Okay? Meaning that if the company decides to close operations, they can basically triple your investment. It's not so fast because liquidations take time, and usually those do not happen because companies want to stay in business and keep producing dividends and so on, not only for investors but for themselves and their employees. But yeah, even in my book, if you read Value Investing, Unlocking the Secrets of Long-Term Wealth Creation, you will see examples of a company that went into liquidation, semi-liquidation. They sold most of the drilling equipment and sold it away, and they paid dividends of 2.5x of the entry price when the stock was undervalued. However, what I was saying is that the world isn't sane. The world doesn't have capacity of focusing on all the things that matter, you know, and they miss opportunities. They cannot focus on all stocks. So it's always like a cycle where you buy at 25 cents on the dollar, sometimes 18 cents, sometimes 40 cents, and then the stock corrects a little bit, and then you sell at 40 cents, and then you repeat if you have the chance of doing it. And basically that's it. You know, if the world becomes sane, many of the bets I have will triple in price, right? But I'm not counting that. I'm not counting with that. I'm more counting with the world remaining as insane as it always been. And yeah, as I told you, you know, other hedge funds, we're talking about allocating 20% into those ideas of this newsletter, focus in stocks that have more attention, that already have people interested in them, and then when the earnings change, when some changes happen, you have news on your side, you have news broadcasters on your side, and so on. So they really know about stocks that are going to move. And perhaps they will have higher returns than I have. However, they will not have the same degree of margin of safety. That's what I sell. That's my truth. That's the truth I have to share it with. That I have to share with you, which is the high margin of safety we offer. And they might offer higher returns. However, diversify. If you're going to talk about investing in them because you like that idea, it's not what I like, it's more about what you are willing to do. You're going to diversify with them. And then you can go 50, 60, 80% with me without getting nervous. But if you invest in those guys, perhaps I'm going to advise you to just allocate 10%, 40%. Myself, the strategy I developed is a kind of strategy where I can put 100% of my savings, and I do that, and I can sleep at night, no problem. That's the type of strategy I developed. I can put the money there and sleep at night, and then it's something designed to be long-term, something to let my savings grow for 40 years, doing the exact same thing and perhaps changing in the future, but that works so far. And Yeah, basically that's it. In my case, you can put 10% with them and 90% with me, and you can sleep at night, right? We can do that. However, the message is that I offer high margin of safety. That's what we do, and I think if I'm going to do something differently, you know, adding a lot of short bets and other stuff, I would rather start a new fund with different name, and that fund selling something different. In the same way, in the previous video, I showed you. I remember like a PowerPoint slide saying that if I want to increase the leverage of Can Capital, I would rather start a new fund called Can Capital 2X with double leverage. I will never increase the leverage of these partnerships because I don't need to, and I sell margin of safety. Okay, and then that's basically the idea, you know. Perhaps myself in the future, I'm gonna put 10% of my savings in these guys in their newsletter, because why not, right? A small amount of money, let's say $10,000, which I hope is 0.01% of my savings. But the message is that if you allocate $5,000 in these guys, and they are really going to survive for a long time with their ideas, this is a lot. This is a lot of money. Okay, so why I'm telling you all of this? Because it's a marketing strategy. You know, I'm new in the industry. I have a couple years of experience, so my marketing has to be giving to you free value. Okay, because that might push you to really take the good decision. If you're not allocating $100,000 with me, or let's say $60,000 with me and $40,000 or $50,000, 50% with these other hedge funds, I can recommend you if you're really addicted to investing in old people with 20 years of experience or something like that. If I cannot convince you to go into the great decision of $100,000, perhaps by giving you some free content, you know, you're not gonna pay me for this video being valuable because people spoiled and they're used to receiving a lot of education for free. They're extremely spoiled. But perhaps with this video, you will decide to pay me for this information by trying it out with a small amount. And because our margin of safety is so high, and because our strategy is designed for the long term, you have no idea how far you can go with this. Or with this, with 50,000, okay? Have no idea how far you can go. The best idea, if you want to go very far, is get into the partnership with generosity.
Be generous and be around people who are generous, because it's a system that works, okay? When you're generous with others, they're going to be generous with you if you have the right side of people. If they're not going to be generous with you, then move on. But that generosity means that you'll get more, as well as that you'll give more. Not only is it functional because of that, but it's spiritually enriching. The relationships that you have are the most important things in your life. So having great relationships and having win-win relationships are invaluable. So be generous and expect the generosity from others.
For God's sake. Go into the partnership with generosity. From this 50,000, you allocate 10,000. Is inside the video? Yeah. Okay. You allocate 10,000 into charities, into generosity, into long-term things, into your grandsons. So you really give time for the partnership to make that money grow. And then the other 40%, you let me know, this is money I'm wanting to use for fun or for perhaps reinvesting in a business idea in 4 years with something different of what I do. And that 40% is, I will know in advance that that's something that you will probably withdraw. You're going to withdraw, of course, more. You're going to withdraw 60,000 or 80,000, depending on how much it grew. But the thing is this, for this to be powerful, you have to get in with generosity. And by willing to leave a part of that deposit for a long time. And then the other part, you can play with it, move it to other fund, to other hedge fund, to your own business. You can do whatever you want with that. You know, it's your money at the end. The partnerships with LPs and GPs is a legal document that is very clear, and it is specified that at any moment you can withdraw your money. For example, we could negotiate, because I really want to have deposits for the long term to really make a big impact in the lives of people. We could specify that certain percentage of the deposit has a lockout of 2 years, 3 years, so you really can test it out, you know. And then that way I cover myself from the fact that maybe in 8 months you will get to know another hedge fund that will get you all excited and wanted to move your capital to them, you know. And you will be able to do so, but with a 40 like 80% of your capital, 40,000 of the 50 you put, you know. It's very important that if you want to take advantage of my high margin of safety and the strategy I offer, you really are willing to leave a small percentage for the long term, okay? And also, I'm not a crazy guy in matters of spending, so all the fees you offer to me and all the performance fees, in case we continue having higher returns, they're going to stay in the partnership. And that money is going to grow, and in 30 years, you're going to have a friend, you're going to have me being very grateful for being the people that really gave me those first, the first clients that really put me in the first places, you know, because I'm young. If I want to be in the first place, in the first places, I really have to start early. And yeah, that's basically it. You know, we go back to the beginning of the video. I was talking to you about generosity and how being generous and letting you keep a bigger percentage of the money we will generate you can capital could be better, because that might attract more people into the partnership. And I would rather keep 20% of the relationship but have 100 investors or 1,000 investors than being more greedy and asking you to give me 50% of what we generate with your leverage, but I will have less investors that way. And yeah, basically that's it. That's what I wanted to expand about. And yeah, as I said at the beginning of the video, I hope you don't have TikTok brain. I really hope you really were able to pay attention to everything of what I said. And if you are not going to read my book, which I was promoting in the previous video, I really hope you have the time to read great books in investing, like The Intelligent Investor and other books that I'm sure will be extremely helpful for your development and to be able to invest in better and better things. And yeah, basically that's it. I hope I wasn't too long this time, and thank you for watching. And remember, I'm always available in the email, on the phone. You really can make questions. I'm transparent. As I explained to you at the beginning of the video, my work, my job, and my business is to tell you the truth. We produce returns by saying the truth, not only to you, but to ourselves. If I lie to myself, I invest in bad companies. If I say the truth to myself, I will let myself know and my fund know about great opportunities. And that's how it works. That's my business. The thing is that if I want to grow even more, I really have to include you, the people watching, into all of this. So yeah, that's it. That's all. Thank you. Many blessings, and see you soon. Goodbye.